Welcome to Staffworks Explained. If you are here for the first time, please consider subscribing to this channel. Also hit the notification bell so that whenever we upload a new video, you are notified. In today's video, we turn our attention to development that could reshape Kenya's long-awaited dream of joining the League of Oil Production Nations. After more than a decade in Turkana County, Tullow Oil has officially bowed out, selling all its local operations to Gulf Energy in a transaction valued at $120 million or roughly 16 billion Kenya shillings. Tullow has confirmed receiving the first payment of $40 million, which is about 5 billion Kenya shillings, signaling that this is no longer just talk. It is a deal that is already in motion. So how did we get there? Tullow Oil entered Kenya in 2010 amid high hopes of turning Turkana into a new oil frontier. Indeed, in 2012, it announced Kenya's first commercial oil discovery in South Lokicha Basin, raising national expectation. Yet, from then on, the company struggled, facing delays in approving the field development plan, challenges in mobilizing financing, wrangles with local communities, as well as uncertainties in global oil markets. Over the years, Tullow searched for partners to shoulder the enormous cost of moving from exploration to full development. At one time, engaging Total Energies and African Oil as co-investors, later pursuing strategic deals with Indian and Chinese firms. None of these partnerships materialized as hoped. With debts weighing heavily on its book, Tullow eventually chose to sell its entire Kenya stake to Gulf Energy in what some observers see as the company's strategic exit. And this is not unique to Kenya. Critics argue that Tullow Oil has a pattern: focus on exploration, build up reserves on paper, but stop short of moving projects to large-scale drilling. In Uganda too, it has sold its stake to in the Lake Albert project before production began. Some experts describe this as speculative business model, where profits come from flipping assets rather than producing oil. Should Kenya have encouraged such an approach? It's a fair question, given the delays and lost time that have cost the country over the decade. Now, Gulf Energy is the driver. It's in the driver's seat, but who exactly are they? Gulf Energy is a Kenyan company, part of a larger Gulf group, with interests spanning energy trading, power generation, downstream fuel distribution. The firm is no stranger to Kenya industry, especially energy sector. It co-developed the 105 megawatts Trump gas-powered plant in Athi River in Machakos County, and has a long experience in petroleum trading. But upstream oil exploration and production, which involves digging wells, building pipelines, and managing large-scale crude exports, is a very different ballgame. The company will need technical expertise, global partnership, as well as billions of dollars in financing to move from oil on paper to oil in the pipeline. On approvals, we can say that the government has already signaled willingness to move faster now that the Gulf Energy has taken over. The field development plan, which is a master blueprint for production, is expected to be finalized soon. With the first tranche paid now, there is a political momentum to push it through. Officials are struggling, or still, they are targeting the 2026 first oil. But given the past delays, observers are remaining cautious. The challenges are steep. Location of oil fields are remote. They require major investment in roads, storage, as well as an export pipeline stretching hundreds of kilometers to Lamu and another port. Financing this infrastructure is not guaranteed, especially in an era where global banks are pulling back from fossil fuel projects, and oil prices remain volatile, which could impact future payments to Tullow and the viability of the Kenya production. Still, the deal carries promise. Gulf Energy CEO Paul Limo has called it a major boost for Kenya energy ambitions, arguing that it could strengthen the country's energy security and finally unlock Turkana potential. For Kenya, the key will be ensuring that this time the project goes beyond boardroom deals to real barrels of oil flowing from Turkana oil fields to the world market. The way forward is clear. Kenya must hold Gulf Energy accountable, especially to timelines, should insist on transparency in contracts and strike a balance between economic gains and environmental as well as community concerns. Otherwise, Turkana oil risks becoming yet another story of wasted opportunity. In conclusion, we can say that Total exit marks the end of one chapter and beginning of another, and we hope that this chapter will be successful. Whether Gulf Energy can turn Kenya's oil dream into reality, this remains to be seen. But one thing is clear or certain: after more than a decade of waiting, Kenya will not forgive another false dawn. So thank you for reaching this far. If it's your first time here, please consider subscribing to this channel. Also hit the notification bell so that whenever you upload a new video, you're notified. You can also like, share, and leave a comment about this, and also watch other videos that we have made on this topic and others in different parts of Africa. Thank you.